Hello, everybody. Thank you for tuning in to the Liberty Report. With me today is our co-host, Daniel McAdams. Daniel, good to see you.
How are you this morning, Dr. Paul?
We're doing well,
right.
and we're excited because we have a special guest today who's going to tell us everything about the bond market and what the future is and when the stocks are going to collapse and what the future of the whole financial system is going to be.
Can't wait.
No, I'm serious. We're going to have a special guest, and his name is Michael Pinto. Michael was on one of our interviews a couple years ago. He's an expert in the bond market. He is the president of Pinto Portfolio Strategies. And Michael, it's very nice to have you with us today.
I want to thank you for having me back on, Ron. And let me tell you, you are the founder, the true founder of the Tea Party movement and the keeper of the flame for constitutional conservatism. And I want to thank you very much for that, Dr. Paul.
Well, thank you. And one reason why you are on our program, and you were on once before, is that I was absolutely convinced that you knew and understood what Austrian economics was all about, and you were practicing it in a business format. And that's what we need, because I agree with you. There's a big change coming. And one of our goals here is to prepare people, not only philosophically be prepared, but financially be prepared, because the more people who know what's happening, the better the rebuilding will be, because this could be a difficult time, and that, of course, is what we want to talk about today. And we'll start off with why about the magnitude of things. We know about school district pension funds. We know about Chicago and states and various things. But isn't this a much bigger deal going on now? It's not located even to a city, town, or state, or Puerto Rico, or even United States. Just give us a brief summary on why you think this is big, and whether or not you agree with me that it might be one of the biggest things ever.
Well, it is the biggest thing ever, Dr. Paul. We are in a global synchronized bond bubble of epic proportions. Some 25% of the developed world sovereign debt has a negative yield. That has never before happened in the history of economics. And we are in the process of seeing that bubble unravel. The 10-year has been higher, maybe it was up at 2.6% not too long ago, but it's now rising from July of last year to where it is today, from 1.6% to about 2.34% on the 10-year note. And the reason why it's such a baneful and pernicious collapse of the bond market, it's ahead of us, we're in the very incipient stages of it right now, is that they've solved nothing. We have solved nothing as a nation and as a globe since coming out of the credit crisis. Global debt is up $70 trillion since 2008. That's $230 trillion altogether, 330% of global GDP. Here in the United States, don't even talk about deleveraging. The United States non-financial debt is up $13 trillion since 2008. So we have a record amount of debt, an explosive addition to the record amount of debt, and yet we have bond yields in a sovereign level that are negative to the tune of about a little bit under $10 trillion globally. So what we're seeing is global central banks have dominated the spectrum of interest rates, but now that's all changing. We know the Federal Reserve got out of quantitative easing in 2014. The ECB is going to start unwinding their tapering in October. They're going to announce it. They'll probably be completely done with their 60 billion euros sometime in the fall of 2018. You only have the Bank of Japan then printing money like confetti. They'll be the only national central bank that's in the counterfeiting game. And we'll have the Federal Reserve, which will be selling $600 billion worth of treasuries. That's the annual pace by the fall. So it's all coming to an end, but it's coming to an end at a very, very unfortunate time for the asset bubbles that exist in stocks, bonds, and in real estate.
Right. You know, Michael, in Austrian economics, there's an emphasis on subjectivity. Objectivity is good. You know what trends are and economic laws are, but there's also a subjective factor. And that, I think, explains sometimes the extremes. Why did this market last so long, when common sense told us, well, this doesn't make any sense. And sometimes on the other end, I remember clearly in 1980s when the 10-year bill was over 15% and nobody wanted it. Nobody could take it. Everything, the psychology was, no, this was a bad deal. People who bought did okay, and the longer the bond, they'd have been all right. And right now, people, interest rates are down to less than 1%, 1%, 2%, and people just keep grabbing it. But go ahead.
Sorry. Well, the reason why they're grabbing is because they're front-running central banks' bids. The central banks have printed $2 trillion worth of confetti to buy bonds so far in 2017. Well, guess what? In 1 year's time from now, central banks will be net sellers of bonds. See, I always laugh about this, Dr. Paul, and you could comment on this. The Federal Reserve, under Janet Yellen, says that they're not going to be selling bonds. They're going to let them roll off the balance sheet. Well, when a bond rolls off, a Treasury note or a bond rolls off a Fed's balance sheet, guess what has to happen? The Treasury has to pay back the Fed, but the Treasury has no money. The Treasury has to sell a bond, sell it to the public at a market-based price, and they have to pay the public interest. Right now, they're paying the Fed interest, and it's credited back to the Treasury. So they'll be selling $600 billion worth of bonds per year of 60 billion per month, so 600 and actually over, so $720 billion worth on an annual rate per annum, starting in the fall of next year. Who's going to buy all of these bonds, and at what price? At what yield? As price goes down, yields go up, and we have deficits, Dr. Paul, I'm sure you're aware. In 2021, our annual deficits due to demographics are going to be $1 trillion. $1 trillion per annum. And you add any of the Trump tax cuts, that's $5.8 trillion over 10 years. For every 1% higher in debt service costs, it's an additional $200 billion. The last time we had a recession in 2009 and 10 in this country, deficits increased by $1.2 trillion. So you could have $3 trillion worth of annual deficits with no central banks involved, a collapse in asset prices. The total market cap to GDP right now, the total market value of stocks to GDP is 134%. That's pretty much at an all-time record high. The average of that metric is about 50%. So stocks are outlandishly valued. If you look at market cap to GDP, they're the second highest outside a small window in the year 2000. If you look at price to sales, they're an all-time record high. Median PE ratios, all-time record high. Home prices in this country, they're at an all-time record high, and home prices are rising much faster than nominal incomes.
Right.
So you have a bubble in homes, you have a bubble in stocks, you have the biggest bubble of all in bonds, and which I can't for the life of me understand, is how the Federal Reserve actually believes they can unwind this unbelievable stimulus with impunity. Mm-hmm. Do you think these asset bubbles can last while rates are rising? And rates have just begun to rise. They're going to spike. Just so you know, the audience understands, the average yield on the 10-year note is about 7%. If you go all the way back to 1949. Right. So, we're at 2.34%. You know how much higher we have to go in yields? And what is that going to do to these markets? That's the big question.
Right. When Bernanke took over and he was talking about Greenspan, there was a lot of talk that people were recognizing, well, we're in trouble now. We have this recession. We kept interest rates too low, too long. and that's when they were 3% and 4%. So they take them to zero. And then they wonder why they have a problem. Daniel has a comment for you and a question.
Well, I was just going to mention Michael's painting a pretty grim picture. You know, we're ready to run for the hills.
Well, we'll finish with a positive thing on this. We're going to know how to, survive.
Well,
all
I
this.
manage money for a living, sir, and my model portfolio is doing very fine. So you can go down with this ship. Don't forget, I hate to interject, but in 2000 we lost half of the market value, 50%, 85% in NASDAQ stocks. We did it again in 2008. So you don't have to go down with the ship. You could short stocks. You could be an active investor. So please ask your question, but you don't have to go down with the ship here.
No, that actually was my question. I was wondering what you are telling your clients with all of this doom and gloom that we're hearing.
Yeah.
Well, the first thing you have to have is some gold. I mean, we have about a 10% allocation in our model portfolio in the inflation-deflation portfolio in gold, not just because of North Korea, which is threatening the existential threat of the end of humanity, but because central banks are going to have to revert to quantitative easing and ZIRP, zero interest rate policies, very, very quickly. You know, I cannot fathom how global stock markets can remain in this bubble in the face of rising interest rates. You know, you have to bear in mind, interest rates are going to be rising not because of economic growth. We've been stuck at 2% since 2010, US GDP. And economic growth, as calculated by the New York Nowcast, is 1.6%. The GDP now from Atlanta model has it at 2.2%. So we don't have any real surge in growth. It's all about central banks removing their bid from the bond bubble. And when that collapses, it's going to take real estate and stocks down with it very, very quickly. So I have about 10% gold right now. That'll be increased as central banks change their mantra. We also are going to be shorting stocks. So you have to be an active investor, not stuck in passive ETFs. I also own aerospace and defense stocks. They've done phenomenally for us this year because of the fact that Mr. Trump, he used to be remember when he was running for office, he was anti-debt and was always squawking about $19 trillion in debt. Now that we have over $20 trillion, he wants to blow up the military spending because one thing about, and Dr. Paul, you can comment about this more than anybody, when you're in D.C., when you're a legislator in D.C., one thing they don't care about at all, other than people like you, is raising debt and deficits. They even want to get rid of the debt ceiling, the safety brake, the smoke alarm. Yeah. I don't understand it. I don't get it.
Yes, and I think this leads to more trouble, and this is what you've been talking about for a long time. And my goals have been to try to get people introduced to sound economic policy, which is the Austrian School of Economics, and also be prepared, owning gold and whatever they can do to preserve wealth. But I also think a lot about what is going to be the replacement. I think this is exciting in a positive way that central banking is really being challenged. The Federal Reserve is being challenged. There has to be something new. And I just want to know what you think about on this. Is there anything to consider positively about what China is doing and some other people trying to develop a reserve currency? Do you think that's practical, or is that just dreaming that they're going to be able to get a gold-backed currency with China and some other countries and replace the dollar?
Well, the dollar hegemony is ending. I don't think it's going to be replaced by yuan or yen hegemony. I think it's going to be replaced by precious metals. You know, as you mentioned, China is going to trade commodities in other things than dollars, and you're going to have a gold-backed yuan. That's wonderful if we back fiat currencies by gold. It wouldn't be fiat any longer. But I just can't imagine how central banks can actually back currencies in precious metals. So why is that so important? If you have a gold-backed currency, that means you can only increase its supply by around 1.5%, whatever the mine supply increase of gold per annum is. It's very, very low, if that high at all. So what happens on the next crisis? And the next crisis is inevitable. It's going to happen. We're going to have a recession. Debt and deficits are going to explode. And central banks have to buy that debt. If they're going to expand base money by, like they did last time, by trillions upon trillions of dollars, they cannot back it by gold. So I think we're going to have a complete rejection of fiat currencies across the board. And any new currency that emerges has to be fettered and restricted and backed by gold. That's where I hope and pray we're headed,
Right.
Dr. Paul.
Daniel?
Yeah, you mentioned earlier the fact that the news is not covering a lot of these issues in a proper way. If you just look at what passes for the news these days, Russia hacking, offensive statues, now we're talking about the NFL. Do you get the feeling that America is really not going to know what has hit it when this bubble bursts?
The financial media is dominated by Keynesian liberals. They are all of one groupthink mindset that says central banks have saved the world from the Great Recession. There's nothing else to worry about. They're on autopilot. In fact, Janet Yellen said that the quantitative tightening, the unwind of its $4.5 trillion balance sheet down to, say, around $2 trillion. Don't forget, it was about 700, 800 billion before the crisis, the Great Recession. She said that's on autopilot. And it's going to stay that way until the calamity strikes. And I will just remind your audience that that's the MO from central banks from the get-go, since they were created in 1913 in the United States. They lower rates, they cause asset bubbles, then these asset bubbles burst and they lower rates again. We have now lowered rates to the zero-bound range and kept them there for almost 9 years. So when this particular bubble bursts, they're going to take the Fed funds rate from wherever it is when the bubble bursts, maybe 1.5%, down to zero. That's nothing.
Right.
That's 150 basis points. When the Great Recession started in 2008, the Fed funds rate was 5.25. So now we're going to have no faith in central banks at all. And the faith is going to be in precious metals, where really it should have been the entire time.
Right. And I want to ask a question about the relationship of interest rates and the value of a currency. Just recently, there was the anticipation that the euro, they may raise the interest rates, and then that would help the euro, if interest rates were raised. And it seems like on short term, that might be true. So our interest rates are going up slightly. Our dollar is bumping around, but in the last year, it's been weak. So if it's anticipating a collapse, this sort of challenges this notion that if you raise interest rates, it's automatically good for the dollar and bad for gold. But I think in the 1970s, as I recall, interest rates were very high and the dollar was very weak and gold was skyrocketing.
Yeah, well, it's all, you can raise interest rates in nominal terms. The question is, what are the real interest rates going to be? And if interest rates are rising like they did in the 70s, but inflation's rising much faster, then real interest rates are falling. Right. And I think that's what the dollar is sniffing out. Now, don't forget, the ECB under Mario Draghi in October is going to start his tapering. And the dollar index is in the low 90s, 93. So in 2008, when we entered into the Great Recession, the dollar index was around 72 because we had a carry trade. People were borrowing dollars and selling them short to buy other currencies, and that carry trade had to be reversed. Well, there's no such carry trade right now. In fact, if there is any carry trade, people are borrowing in foreign currency, shorting them to buy dollars to get our higher yields here. So the next crisis, gold could be a big winner right from the start. But like I said, it's all about real interest rates. And I think all fiat currencies are going to realize, and all holders of fiat currencies are going to be very, very surprised when they realize that real interest rates are going to remain negative indefinitely, in perpetuity. Right. And that's when you get a real surge back to all-time highs in precious metals, particularly gold.
Michael, we're running out of time, but I did want to ask you a question about whether or not you think cryptocurrencies are going to play a role as a free market instrument in smoothing things out, or is this just going to cause more confusion?
Well, I mean, they could. I mean, I'm not the best person to ask on this because I just don't understand how something that's not tangible, that's not really actually doesn't even exist. It's actually an IP address in a digital wallet. It can never supplant gold. See, why is gold so special? Gold is very, very rare, and it's virtually indestructible. Cryptocurrencies don't work when the power goes out. An electromagnetic bomb. Cryptocurrencies are being created by the hundreds per month. There's almost 1,000 cryptocurrencies out there right now. I am not aware of scientists discovering any new element out there that's extremely rare and virtually indestructible. That's why cryptocurrencies, the idea behind them is very real and very necessary. They're trying to escape the world of fiat currencies. But we have something. We have something that already fulfills that role. It's called gold. And there's a company that I own, in full disclosure, called Gold Money, that actually has a private blockchain that enables you to move gold around the world in tiny fractions of grams. So essentially, it's Bitcoin backed by gold.
Right.
So you turn gold, the perfect form of money, into the perfect currency. There really isn't any need for cryptocurrencies, although I completely understand the desire to have them in place.
Well, you know, there was one time on the banking committee, I asked Bernanke point blank, is gold money? And you may have heard, he was very, very clear. He said, gold is not money, but I think the market will decide that. And 6,000 years of history are on our side. So, Michael, I do want to thank you for being with us and make a closing remark, and then we'll close our program.
Before he became Federal Reserve, he was a student of Ayn Rand and a follower, and he was a gold bug. So I guess he changed his mind.
Yeah, right. But it's great to have you with us today.
Thank you so much for having me back on, Dr. Paul.
Yes, and I want to thank our audience for joining us today, and I hope you enjoyed the program as much as I did. Please come back to the Liberty Report soon.